So this is the first of 5 different sample reinsurance practice problems. This one we're going to look at reinsurance accounting using pro rata reinsurance to get surplus relief. I've reordered some of the T accounts here just for the purpose of the video itself. But you'll notice that this balance sheet should look pretty familiar. We have basically the same different accounts as you had in the 30/20 class. You have cash for $2 million, stocks and bonds for $3.6 million, for a total of $5.6 million. And on the liability side, you have unearned premium reserves of $600,000 and policyholder surplus of $5 million, again for $5.6 million. The one thing that you will see is that on the T accounts, there is no loss reserve. And that's because really no time is going to be passing here. We're going to have $12 million of premium written all on December 31st, 2017 with a 31% expense ratio here. And all of that's going to happen in one day. So we're going to assume that really no time has passed, and so there's no time to accrue a loss reserve. So we're really just looking at the impact on cash, unearned premium reserves, and policyholder surplus. Again, we have $12 million of premium written. So let's look at the impact of just that occurring. And we'll go first to the T accounts. So if we write $12 million, remember that we put $12 million in cash because we literally get $12 million of cash. So it's a debit to cash. But we set up an unearned premium reserve, a credit, because it's a liability, and so it's an increase in the unearned premium reserve of $12 million. And then for our expenses, 31% of the $12 million equals $3,270,000. So we'll put that as a credit to cash. I'm going to label that expenses, and a debit to income. $3.27 million. Again, that's expenses. And that's basically it. So we have an increase in unearned premium reserve of $12 million. And our change in income is a reduction of 3.27. Because remember, we wrote the $12 million and really no time has passed, so we haven't earned any of it yet to reflect in income. And the difference here in cash is an increase or a debit to cash of $8.28 million, which is just our $12 million minus our $3.27 million. So let's go back to the balance sheet, and our cash will be the $2 million here plus the $8.28 million. So that's $10.28 million. Stocks and bonds don't change, 3.6, for a total of $13,880,000. And on the liability side, we have unearned premium reserve now of $12.6 million, which is our $600,000 here and our $12 million here. Loss reserves don't change because, again, we're assuming really no time has passed, even though one day has really passed, but we're ignoring that. And our policyholder surplus goes down from $5 million, subtracting $3.27 million, to $1.28 million. And so that really causes a surplus drain because of those expenses and not being able to recognize our earned premium yet. And again, we have 13,880. And I apologize, all of this is not fitting in there very well, but you can see the numbers. So what this is showing the impact of purchasing a 70% quota share, which is the most common and the simplest form of pro rata reinsurance. 70% quota share is simply saying that we're going to transfer 70% of the liability, losses, and premium and loss adjustment expenses to the reinsurer. And we're getting a 33% commission on the premium that is transferred to the reinsurer. The numbers that we're going to use down here are going to just show the impact from here to here on purchasing the reinsurance. So what happens in the T accounts here is going to be applied to the balance sheet after we've written that $12 million premium. Whether that's one policy or multiple policies, it doesn't matter. So what are we transferring to the reinsurer? Well, that's going to be our $12 million times 70%, which is $8.4 million. And so that is the amount that is ceded to the reinsurer. And let's go ahead and calculate our ceding commission. The ceding commission is the 33% as a percentage of the ceded premium. And so that is $2,772,000. So now let's bring this down to our T accounts. So we ceded $8.4 million, and because that's ceded, that is us purchasing reinsurance from the reinsurer. And so it is a credit to cash, which is a reduction in cash because we have to give the reinsurer $8.4 million. And it is an offsetting debit to unearned premium reserve because when we transfer that $8.4 million, we're literally transferring it from the unearned premium reserve to the reinsurer. The other thing that happens is we get back $2.772 million in ceding commission. And so that is a cash transaction, but it is also a credit to income, an increase in income. We get to reflect it as income, which is also known as our surplus relief. So the ceding commission is the surplus relief. So our balance on cash is $5.628 million. And I won't do the other balances because there's only one thing going on. So back to our balance sheet. We had cash of $10.28 million, and we subtract, this is a credit to cash, so we subtract the $5.628 million, and that's $4,652,000. Stocks and bonds don't change. And unearned premium reserve goes from our $12.6 million down to $4.2 million. Here, I'll do it up here. Impact on unearned premium reserve of quota share is $12.6 million minus $8.4 million. And that's $4.2 million. So we've really reduced our written premium, which means that we've actually increased our capacity. Our loss reserves doesn't change. We just buy this reinsurance basically at the same time as we write the $12 million. And our policyholder surplus is now the $1.28 million plus our ceding commission of $2.772 million. That's our ceding commission. And that gives us $4,052,000. And so that's $4,052,000, which gives us a total of $8,252,000. And let's look at it over here, $8,252,000. So one last thing I want to point out is that if we calculated our premium to surplus ratio before reinsurance, we have premium, and we're going to just use our unearned premium reserve because that's a good measure of premium, of 12.6 to surplus of 1.28 million. And when we calculate that, that's 9.84. So that's a 9.84 to 1 ratio. Remember, we're trying to keep 3 to 1 or less. But down here, we have 4.2 divided by 4.052. We already know this is going to be a lot better. 4.2 divided by 4.052 is a 1.04 to 1 ratio. That's our premium to surplus ratio, which was brought to us by the surplus relief from the ceding commission and the reduction in unearned premium reserves because we ceded some of that premium off to the reinsurer. And that's it.